The role of income statement analysis in industry benchmarking. The income statement reveals a company's revenue generation, cost structures, and net profit trends over time. When compared to industry averages, these figures highlight whether a firm is outperforming or lagging behind its competitors. Cross-industry comparisons require adjustments for scale, market conditions, and growth stages. For example, a tech startup might show lower gross margins than an established manufacturer due to different capital intensity levels and R&D investments. Gross margin ratios. Compare gross profits as a percentage of sales to assess pricing power and production costs relative to industry benchmarks. Operating expenses. Analyze SG&A ratios to determine if overhead spending is aligned with peer companies in the same sector. Discrepancies in income statement metrics often signal underlying issues. A declining operating margin may indicate rising competition, inefficiencies, or mispricing strategies requiring immediate attention. Accountants must also consider non-recurring items and one-time charges when evaluating performance. These anomalies can distort year-over-year comparisons unless properly normalized during benchmarking exercises. Evaluating balance sheet metrics across industries. The balance sheet offers insight into a company's financial health through assets, liabilities, and equity composition. Benchmarking this information helps identify risks related to debt levels, working capital requirements, and asset utilization efficiencies. Different industries have varying capital intensity requirements. Manufacturing firms typically maintain high fixed asset bases, whereas service-based businesses emphasize intangible assets like intellectual property and human resources. Leverage and solvency benchmarks. Debt-to-equity ratios provide a snapshot of a company's reliance on borrowed funds versus shareholder capital. In highly regulated sectors like utilities, higher leverage may be standard due to long-term infrastructure projects. However, excessive indebtedness poses solvency risks, especially in volatile industries such as technology or retail. Comparing interest coverage ratios to industry medians helps quantify a firm's ability to meet debt obligations during downturns. Current ratio and quick ratio analyses further reveal liquidity positions. Retailers, for instance, usually operate with tighter current ratios because of seasonal inventory cycles and customer credit policies. Cash flow statement insights through sectoral lenses. The cash flow statement complements income and balance sheet data by showing actual inflows and outflows of cash. Benchmarking this metric uncovers discrepancies between reported earnings and real cash-generating capabilities. Cyclical industries like construction or automotive face significant variations in operating cash flows depending on economic phases. Conversely, stable sectors such as healthcare exhibit more consistent cash flow patterns year-round. Free cash flow generation. Assess free cash flow per share against industry leaders to gauge reinvestment potential and dividend sustainability. Capital expenditure trends. Monitor CapEx percentages relative to revenue to determine if a company is investing appropriately in future growth initiatives. Companies with strong operating cash flows but negative financing activities may be deleveraging strategically, a trend worth highlighting during client consultations. Comparative analysis of cash conversion cycles can expose inefficiencies in receivables, payables, and inventory management processes that impact overall financial flexibility. Profitability indicators and their industry contexts. Return on equity, ROE, measures how effectively shareholders' investments generate returns. However, this metric varies widely based on industry characteristics and corporate governance models. High-growth technology firms often prioritize reinvesting earnings rather than distributing dividends, leading to elevated ROEs despite low payout ratios. Meanwhile, mature industrial companies tend to return excess capital through buybacks or dividends. Net profit margins. Evaluate net income as a percentage of revenue alongside industry peers to detect competitive advantages or structural challenges. EBITDA multiples. Use EBITDA valuations to compare enterprise values across diverse capital structures and tax environments. Accountants should caution clients against relying solely on absolute numbers. Instead, they should contextualize profitability metrics within relevant industry benchmarks and macroeconomic factors. Seasonality effects significantly influence quarterly results for certain sectors. Retailers, for example, experience sharp fluctuations around holiday periods that skew interim reporting outcomes. Liquidity management strategies by sector. Working capital management differs markedly among industries, necessitating tailored approaches to liquidity optimization. Service providers generally maintain leaner inventories compared to manufacturing enterprises. Receivables turnover ratios help quantify collection effectiveness. B2B companies typically achieve slower turnover rates than consumer-facing organizations with instant payment systems. Days Sales Outstanding (DSO). Track DSO changes over time to measure improvements in accounts receivable management practices. Inventory turnover rates. Compare stock rotation speeds across sectors to identify best-in-class supply chain operations. Firms facing aggressive supplier terms might benefit from negotiated payment extensions, improving cash flow without sacrificing vendor relationships. Technology advancements now enable real-time visibility into cash positions, allowing proactive liquidity decisions that align with both business objectives and industry expectations. Risk assessment frameworks using financial benchmarks. Identifying financial risks requires cross-sector comparisons of volatility indicators such as beta coefficients, price-to-book ratios, and earnings variability measures. Volatile industries like commodities trading demand robust risk mitigation strategies reflected in their financial disclosures. These include hedging instruments and derivative contracts disclosed in footnotes. Operational risk exposure. Evaluate exposure concentrations through segmental reporting and geographic diversification metrics. Interest rate sensitivity. Calculate duration gaps to understand how changing rates could affect bond portfolios and loan commitments. Regulatory compliance adds another layer of complexity, particularly in heavily monitored fields like banking or insurance. Accountants play vital roles in interpreting complex disclosure requirements accurately. Scenario analysis becomes essential when forecasting future risks. Stress testing balance sheets under adverse conditions ensures preparedness for unexpected market shifts. Strategic decision-making enhanced by comparative data benchmarking facilitates informed decision-making regarding mergers and acquisitions, capital raising efforts, and expansion plans. It enables identification of undervalued targets or overpriced assets within markets. Investment choices become clearer when comparing PE ratios, EV/EBITDA multiples, and other valuation metrics against historical averages for respective industries. Mergers and acquisitions leverage comparative data to assess synergies and integration feasibility before pursuing deals. Cost reduction initiatives identify areas where process improvements can match or exceed industry-leading cost efficiency standards. Board members rely on these insights to make strategic resource allocations that maximize shareholder value while managing downside risks prudently. Data visualization techniques enhance presentation quality, making it easier for executives to grasp complex benchmarking findings quickly and act decisively. Emerging trends in financial statement benchmarking. Artificial intelligence and machine learning algorithms are transforming traditional benchmarking methodologies by identifying subtle correlations previously overlooked by manual analysis. Predictive analytics now allow forward-looking assessments beyond static historical comparisons, incorporating macroeconomic forecasts and geopolitical developments into financial modeling frameworks. Real-time analytics platforms enable continuous monitoring of key metrics against evolving industry baselines through cloud-based solutions. Blockchain integration enhances transparency and audit trails for transaction records used in benchmarking exercises across global operations. Sustainability metrics increasingly factor into benchmarking criteria as ESG considerations gain prominence in investment decisions and regulatory frameworks worldwide. Professional development remains crucial as new technologies reshape expectations for financial reporting accuracy and analytical depth required from modern practitioners. Conclusion: industry-specific financial statement benchmarking empowers professionals to deliver nuanced insights grounded in empirical evidence rather than assumptions. This practice supports better-informed strategic choices at every level of organizational hierarchy. To stay ahead in this rapidly evolving field, accountants must continuously refine their benchmarking skills, adopt emerging analytical tools, and maintain deep familiarity with sector dynamics shaping contemporary financial landscapes.